Well, as of a few weeks ago, the Democrat Party now has the White House, the Senate, and the House of Representatives. Now, if I asked you whether the stock market does better when Republicans are running things or when Democrats are running things, what would you guess? Actually, it's a little bit of a trick question. The stock market does the best when we have a divided government. In fact, if we look at the S&P 500 back to 1945, the modern era of investing, if you will, 75 years of history, the best combination is divided government, Republican president, Republican Senate, and a Democrat House of Representatives. Sound familiar? It should. That's what we've just had for 2 years. And that combination has happened 10 times over that 75-year history with an average rate of return of 17.6%. But what if government isn't divided? Did you guess when Republicans are running things? That's happened 6 times, and the average rate of return is 12.9%. And actually just a little bit better than that is when Democrats are running everything. 14.5%. And 22 times that has happened since 1945. Now, for years, you've heard me say that one of the dumbest things that an investor can do is allow their political leanings to affect the way they invest. In fact, for all the talk I've heard recently about how if Biden wins, this whole thing's going straight to you-know-where in a handbasket. It's been interesting to see the huge jump that we've had since Election Day. In fact, in the last 5 presidential terms, this election bump has been the biggest. 14% jump between Election Day this year and Inauguration Day. In fact, you may remember the Trump bump. The next day after Trump's election, the market took off. And yet that was only a 6% growth from Election Day to Inauguration Day. Now, there are several positive trends sending optimistic signals for the near term. We all know that things aren't just trading on a Biden election right now. Some of those positive trends, one of which we've talked about multiple times. The major driver for this market is the reopen from pandemic lockdown. Day by day, inch by inch, as we creep towards normal, the way life used to be. Our progress, continued progress on COVID-19, be it vaccines or treatments, reopening restaurants and businesses. The closer we get to normal, the better things feel. And of course, the market is anticipating that. Obviously, more stimulus is on the way, another 1.9 trillion. Each time we've had some stimulus, the market has loved it. We've actually also had a strong earnings season so far. A fairly positive increase, in fact, 6% above expectations. The Fed is also expected to keep rates low where they are. Now, that said, this year may be the year to keep our heads on a swivel. Taxes appear to be going up, and higher corporate tax rates combined with what's likely to be increased regulation is, very likely to eat into profits. Now talk of a $15 minimum wage, likely to create inflationary pressure. Now, my goal, as always, is to help you navigate a year, this year, where maybe we continue to expect that these positive trends pay off for investors, but also needing to navigate the twists and turns and keep ourselves on this journey. Our time-tested process of asset allocation, diversification, and rebalancing, keeping us on that journey. As a disclaimer, the opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested in directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee the strategies promoted will be successful.